Should I pay off $400,000 in debt with 8% interest rate or continue to use that money to invest in the stock market? Especially because that money is now sitting around $1.2 million. Well, that's not my question. That's the question that's surfing on the web, on Twitter, that one guy has that he posted that he made about 1.29 million, about 175% year-to-date return from T-locking their home, while $412,000 of debt that's running around 8% interest, and he's paying about $2,843 a month in payments, but he's definitely made a lot of money from investing at the bottom of 2022 towards the end, because as you can see, the stock market's been rallying since the bottom of 2022, and he's perfectly nailed the markets by buying the lows there. Because if you look at, let's say for example, NASDAQ's about 7% away from all-time highs. So I'm gonna go over this question. Now before I do, I'll leave a link in the description so you could read up on it as well. My name is Daniel. I run an organization called InfraVest. InfraVest is an organization that promotes financial literacy, teaches you about the macro news, ties it all up with stocks, bonds, commodities, currencies, and Forex and crypto as well. If you like content like this, hit the subscribe button, the bell icon, and the like button as well, and you'll see more content in the future on macro news and finance and many more things as well. Now, let's get into this question. It says, should I pay off $412,000 in HELOC debt at 8% interest or keep investing in the stock market? I borrowed $412,000 in my HELOC towards the end of 2022 because I thought it was a great time to buy stocks when the market was crashing hard. The interest rates, however, has continued to increase, and the interest payment alone is now $2,843 a month. But I have made good returns in the market, and I'm up 175% year to date. My account value now sits around 1.29 million. My take-home pay is $28,000 per month. Not bad. However, after all monthly expenses accounted for, every single penny left over, about $16,000 a month, is getting saved to pay short-term gain taxes by next year of 2024. My question, would you withdraw from the stock market account to pay down HELOC immediately, or keep invested to compound more gains over time and instead use job income to pay it off over the next 5 years or so? So if I was Dave Ramsey, I'll try to mimic him, I would be like, are you crazy? You should pay off that debt right away. Are you insane? You make what? $28,000 a month? And you're asking me, should you pay off the debt? And you made what? 175% year to date? Turned it 400K into 1.29 million? Are you crazy? Okay, anyways, jokes aside, good job. Good job buying the dip in 2022. Good job making that money, right? And there's some comments here that are pretty good comments. I'll name one here. I think it comes out from the Aggressive Value. That's the Twitter handle. Basically says, assuming you are left with $900,000 after tax, you should pay down HELOC, which will leave you with $500K to invest. You now have the HELOC available in case another huge opportunity makes itself available down the road. I totally agree. Totally agree. Should not be over leveraging, over getting crazy with debt, especially as rates are moving up higher and higher, and especially when you look at the macro side of things, okay? Let me bring in a little bit about macro here. When you look at what the Fed is saying, the central banks around the world, they're out there to tackle inflation, right? And they're doing this by hiking rates aggressively. And they're not standing down, they're not cutting rates anytime soon. And even if they plan to pause rates, those rates are expected to be higher for longer. Now, if rates are expected to be higher for longer, according to valuation metrics and whatnot, if rates are higher, how is that going to look when it comes to profitability, growth metrics for a lot of these companies and the stocks? Now, I understand NASDAQ is 7% away from all-time highs, but if you look at Dow Jones and the rest of the markets out there, the stocks haven't been really rallying. It's really about 6, 7 stocks out there that's been lifting up the indices, especially the tech index, right? But Dow Jones itself is trading sideways. Russell 2000 trading sideways. S&P is being lifted by some of these tech stocks because they're in that index as well. So very few, select few of these stocks are pushing up higher, and not majority of the other stocks out there. Majority of them are still at quite relative low levels, and that's because, hey, rates are higher. And when you look at that from a valuation point of view, how can a company continue, a business continue to do well in an environment where rates are higher, right? How can they continue to do well in their earnings and growth, especially when it comes to their valuations? How can they do well, especially if interest rates are higher? Because when you do a valuation, you do take into consideration interest rates, the cost of capital. If the cost of capital is high up there and you're paying a lot on your debt and your interest, then there's less money going towards the return on equity, to the shareholders, to you, the business itself, and for it to grow. So it would be very, very difficult. So with that in mind, with keeping in mind that, hey, if let's say you think there's no recession, but things are expected to be okay. If things are expected to be okay and the central banks around the world, especially the Fed, is telling us that they don't expect any rate hikes, don't expect any rate cuts anytime soon, maybe 2025, then that means rates are going to be higher for longer. That means the interest rate that you're paying could be higher, could be, where it is right now, but you'll be paying that for a very, very long time, right? So the question is, does that make sense for you? And most importantly, the most important thing, which is even more vital when it comes to making decisions, is what if you're wrong, right? You said here at the end that should I pay it off, or should I continue to be invested in the markets, use my job income over the next 5 years or so, right, to pay off the interest? And you're saying here that 16K, whatever you saved, all that money is going towards taxes. Let me bring another scenario here. What if you lose your job, right? You're making $28,000 a month, amazing. But, all your money is going to either your expenses, to paying off the debt, the interest there, and most importantly, whatever you're saving is going to paying the tax man. What if you lose your job? Now what? The 16K that you saved, that you generally saved, that's going to the tax man, is going to end up being money that you owe to the tax man. And now you've got a HELOC, a home, a mortgage, interest on the HELOC, interest on that mortgage, whatever expenses you have, and you have no job. Now that scenario, you have to contemplate and run a scenario that if that happens, will I have enough money saved on the side to handle that and get a job, within the next couple of months or 6 months? Do I have 6 months of savings, emergency savings, to handle these expenses, right? Many people do, many people don't. And what if in those 6 months you're unable to get a job? What if something does break in the economy and there is a recession by the next year, the first half? What if that happens, right? And also you're invested in the markets, 400K, right? You're sitting at 1.29 million. What if that completely contracts? The markets crash, right? Because if you look at past recessions, 2001, 2008, right? We saw markets go up as the Fed was hiking rates, markets were going up, and markets completely went the other way and plunged when the Fed was cutting rates. And you would think, hey, if they're cutting rates, the market should go up, but it did the reverse because there was some sort of event that happened, a big recession, a big crash that happened that followed after, some sort of event. What if you get that some sort of event? What will you do then, right? So I'm not a financial advisor. I'm not an investment advisor. You definitely should not take any advice from me. Always consult a registered investment advisor. But when it comes to just simple risk management, right? It's always best to choose risk management over anything else so that you're able to sleep well at night, right? So that you're not in any situation down the road where you not only miss out on an opportunity if there is lower stock prices down the road, but you don't put yourself in a situation where you have to crawl out. It's going to take you years and years and years to fix, right? So just like the aggressive investor says here, pay off the damn HELOC. You did a good job, made so much money, right? And after you pay off the HELOC and your taxes, assuming that it's 900K, after paying everything off, you'll be left with around 500K to invest. You can take that 500K and do whatever the hell you want with it, right? It's your money. You don't have to worry about it. You could keep it on the side. You could keep it invested. You could keep half invested, keep half cash on the side if you believe there's going to be another opportunity, right? Or, you could invest the full amount and you still have your HELOC available if you need, right? It's always best that if you have a view, no matter what your view is, you could be right, you could be wrong, but it's always best to hedge yourself. Hedge, whether you are bullish, hedge yourself on the downside. Whether you're bearish, right? If you believe the markets are going to come down, hedge yourself. How do you hedge yourself? Well, what if you're wrong? The markets don't come down. Then you want to have a side of your portfolio that does well when the markets are going up and also does well when the markets are plunging and going down. So same thing, if you have a portfolio that markets are going up, then hey, yeah, you want to have some sort of buffer net, safety net that markets are going up, they're close to all-time highs, we've been rallying like crazy, euphoria in the markets. Don't you think for a little bit you should have some sort of hedge on, right? Maybe you're feeling that, okay, we're going to get all-time highs and whatnot. It's good practice, an idea to always safeguard your profits, your money and hedge, and especially not to over lever. Now, in this situation, you are using debt and you want to eliminate that situation, pay it off, right? And then be in a situation where you're utilizing your own money, right? And risking what you're willing to throw out there, risking what you're willing to lose, really, is what most people should look at when it comes to investing and trading. But hey, this is just my own opinion. I'm just a simple guy with a simple YouTube channel. Let me know what you guys think. Again, this is not financial advice, not investment advice. I'm not a registered investment advisor. Always consult with a registered investment advisor or financial planner. They've got the best decisions, best ideas, and they can work more tailored towards your needs and your wants and your situation. So leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.